Thank you guys for coming. What a crazy week it's been, and we'll definitely get into all that fun stuff. There's a lot going on, but we're here for another episode. This week we have Silo Finance here, and we'll talk a little bit about that. But before we get started, I just wanted to give a quick friendly reminder that nothing said here is financial advice. We're not financial advisors, strictly for educational and, like I say, sometimes entertainment purposes. And another thing, just a quick shout out to my partners at Binance US. No trading fees on ETH and BTC. You can check out my pinned tweet. And with that, with the disclaimers out of the way, Dal, I know you're back, so your week has been a little hectic, but Tammy, how's your week been?
It's been good, actually. Dave and I had a great day yesterday. We had a few things happen that were really good, so it's been a great week. It has been a little hectic though, as you know, with my dog, and then I threw out my lower back. I don't know what the world I did, but I guess welcome to your 40s. But other than that, it's been a great week. I've just been trying to calm some fears of some people in real life that I know with this whole banking issue. So I do get people contacting me about that, but maybe we can get into that in a little bit. I just want people to not be so scared about things. So, but it's been a great week. Hopefully for you guys, it has been as well. How's your week been?
Yeah, I was like I mentioned in the group chat, so I did have coffee this morning with a friend, and she's like so oblivious, like IRL friend, to what's happening with the banking crisis. Her story of the week was that Kanye got married again, and apparently I'm supposed to know and be keeping up with this stuff. But yeah, like the differences of what our priorities are in totally two different spectrums. But yeah.
Oh my God, I didn't even know that.
I know,
I'm
there
learning
you
something
go.
today. Who knew? Yeah,
Yeah.
I don't pay attention to that stuff anymore.
Yeah. But yeah, let's go ahead and kick it off. So who do we have here from Silo Finance?
Yeah, absolutely. I'm Tenzent. I'm the head of BD at Silo Finance. But really, we do a little bit of everything at Silo. We are a very tech-heavy team, so we have a lot of developers. The business team is basically me and one of our co-founders, Aham. Um, but yeah, we do risk-isolated lending, and I think we'll get more into that later on. But yeah, pleasure to be here.
Yeah, we're happy to have you here. I know, Dal, you're pretty familiar with Silo Finance, right?
Yeah, when it comes to lending, I think it's one of the most exciting projects in the space. They've also recently onboarding onto Arbitrum. And to provide a context to that conversation, right? Like I think most people are familiar with Aave, where you can kind of have like, deposit your tokens and borrow against another token. There's always this risk that looms in the surface because of the model that Aave has. And so there's been like newer generation of lending protocols that try to improve on the Aave model and make it safer for lending and for borrowing. So Silo is definitely one of those exciting projects and work in that direction.
And can you, and for either one of you guys, could you maybe elaborate, like what are some of those current risks with some of the lending platforms like Aave? And then maybe we can start talking about, how Silo is a little bit different and how it could benefit.
Yeah, sure. So Aave's Aave, Compound, Euler, all of the platforms, they use what's called a shared pool model. And what that means essentially is all of the assets inside of the smart contract live in the same smart contract. So when you look at Aave, you can deposit ETH and borrow wrap BTC or Blink or whatnot. But actually, what that means in the engine, if you would, of Aave is that all of the assets are mixed together, and if one of the assets goes bad, or if say there's not enough liquidity for an asset, or if just the oracle of one asset gets manipulated, then that effectively could end up with the entire pool being drained. So there is this risk
Wait,
of what
really
we call
quick before
contagion.
you go on, just to make sure I can wrap my head around this. So, like in the example of USDC, like being pegged, would that be an example of something like that?
Yes, exactly. So let's say USDC went to absolute zero, then if the Oracle failed, users would still be able to come in and deposit USDC and borrow out all the good assets out of Aave, effectively wrecking the protocol. And we've seen this multiple times, by the way. This is actually the most common reason that lending protocols get hacked. It's contagion. You see it with Cream. You see it with Mango Markets, where you just pump the token of the price of one token up, and then you borrow out all the other ones. But Silo is fundamentally different in that sense. So what we really do is we create risk isolated pools. So you can think of it as a bunch of mini Aaves. And so we have markets for every token, and every token is always paired with the same thing. So you'll have a Curve, ETH, USDC market, or on mainnet we use our own stablecoin called Zai. But on Arbitrum we use ETH and USDC. And so we have this common bridge asset, and then what that means is essentially if one market goes up in flames, it has no effect on any of the other markets.
Makes sense. Makes sense.
Yeah, one thing I could add to that, right? Because some of it may sound like implementation details, but what that translates to average user is if you go on Aave, even if you think of it like what it looks like today, what it probably will look like long term, you'll only most likely have access to very like high, large cap tokens that have been vetted because they're the only ones that they can actually they'd be willing to actually take the risk of contagion with the overall smart contract and pools of other tokens, right? Because if they introduce like a smaller token that can be manipulated, they don't have like a clean way to separate that risk from the risk of the other tokens, right? So they really have to keep only like large tokens that have massive liquidity and don't seem to be risky, versus what Silo is introducing, the separation of pools. Now you can, in theory, have access for lending and borrowing on smaller asset or riskier asset because their risk is unlimited to their own pool. So to the average user, what that looks like is greater access to way more tokens to either lend or borrow. So that's pretty exciting. Like even like the smaller tokens will now have access to lending as a service.
Yeah, that's exactly right. And we can theoretically, because of our model, we can list an infinite number of pools, and that doesn't just extend to tokens. That extends to complex derivatives, LP tokens, really anything, because there isn't any added risk by introducing new collaterals into the system.
Great stuff. Great stuff. So maybe give us just an overview of what are some of the products that you offer. So if I'm a user, I know you talked about lending, you talked about some yield farming. So what are some of just at a high level of the different products that you guys offer?
Yeah, so I mean, at our core, we're a lending platform. The products I would say are more of the variety of tokens we offer. So if you go on Silo's app, you'll see that we have lending markets for basically, a lot of tokens that you'll find nowhere else. And people are not too familiar with the things you can do with lending, but something I like to, do myself is you can, deposit something like a stable coin and then borrow out a coin with a high inflationary rate. So something like Aura, for example, if I deposit Zai, which is our stable coin pegged to basically USDC, and then I borrow out Aura, I can subsequently stake that Aura inside of the Aura gauge, although it does have a lockup. So, each strategy has its own kind of contingencies, and you can earn something crazy like 50 to 60% APY, right? And that's on stable coins because when you borrow something, you are never exposed to it until you sell it. That's just kind of one of the core things with lending. Yeah, and the same thing can be said for leverage. So if you're using a lending market, borrowing a stable coin, buying more of the base asset, redepositing it, borrowing out more stable coin, what that creates is a leveraged position. And then you can actually do the opposite to create a short position. Yeah, and then I guess, are more complex collateral types that we really haven't released them yet, but they're coming. They're coming very soon. We've been working on using Curve LP tokens as collateral and allowing people to also earn the full amount of their convex rewards while being allowed to borrow against it. And if you can borrow a stable coin against a Curve LP position for a stable coin, you can create leverage scenarios where you're, having astronomical APYs.
Damn, pretty cool. What's the, we kind of answered that a little bit already, but like, what's the typical borrower? What do they look like? Are they DGen looking for leverage, or they're more like maybe like market makers or some kind of institution? And then on the flip side, who's the typical lender on Silo? Is it just hodlers? They're looking for some kind of return and not just sit on the tokens, or maybe more sophisticated players?
Yeah, so I mean, the biggest use case we've seen really is leverage. Users like to take long positions. They perhaps don't have the capital to increase their exposure, so they opt in for a loan. And actually, lenders and depositors, they are to an extent the same person. All right, when you come in and you borrow something, you have to first deposit collateral, and that collateral can subsequently be borrowed by others. But yeah, we do see a bunch of really different, as you could say, like archetypes of users. The primary one is leverage. You've got delta neutral farmers. That happens, and then we have stablecoin farmers. So there's a lot of assets listed with us, and they on the mainnet anyway. They have they're paired with our stablecoin, which you can borrow, and our stablecoin can be staked for around 20% APY. So users come in, a lot of them, and they deposit their base asset, then they borrow out the stable coin, and they stake the stable coin inside of our Curve LP pool.
Okay, pretty cool. I know that Silo is aiming to become like the Uniswap of lending, right? Where in theory, let's fast forward like 2 years from now, you move to a permissionless model. Anyone that has a token can then jump into Silo and provide lending and borrowing, right? What are the steps for you to get there, right? Because right now you're not quite to that place. Like, is there like an update to the smart contract or some risk management that you have to do before you get there? Like, what are the steps to get to that Uniswap of lending model?
Yeah, so I mean, we're actively working on our V2. It's gonna take a while, but and I can't reveal too much about some of the more core features, but I will say at our heart, it's always been the goal to be permissionless as possible, to incentivize developers to build their own oracles. Yeah, the goal, I think, towards going to the Uniswap model is really about removing governance. We have some governance layer on our contracts, but we also use non-upgradable contracts, much like Uniswap. They're immutable with some small replaceable components. But the goal is to basically make it completely immutable, such like a Uniswap pair, and allow deployment of markets completely permissionlessly. Yeah.
Go ahead, Crypto Jesus.
Yo, Dow, I like the new pick. Tammy, Jez, good to see you.
Good morning.
GM, it's great to meet the Silo team. I have a question. Since your contracts are not immutable now, is one of the other reasons why you're moving to this immutable style of contract deployment for security concerns as well?
Oh, actually, our contracts are immutable right now. They're non-upgradable. We don't use any proxies. There's some very small replaceable components which are controlled completely on-chain by our DAO, and they're also locked behind a time lock. So any changes that the DAO makes, you have plenty of time to kind of respond if you think that you don't like them. But yeah, the DAO doesn't control any assets. The DAO can basically only change up interest rates. It can add bridge assets, and it can change oracles because you have sometimes the issue of an oracle going bad or being deprecated, like you see with some Chainlink feeds.
So is that a security concern? Let's say, for example, you have an oracle that's reporting price data inaccurately, could that cause a lot of damage to users?
Yes, a bad oracle, a faulty oracle is probably the worst thing you can have in a lending protocol. We currently use Chainlink, Uniswap v3 TWAP oracles, and some Balancer v2 oracles, and we're working actually to integrate many more different oracles into the network. But yeah, we do, Chainlink for the most part, it's not really going to report wrong price. But for something like Uniswap v3, there are some considerations that you have to make, and we actually have an analytics page that shows you exactly the costs to manipulate the oracle, because those are easily calculatable. And users can kind of see, I mean, it's ridiculous for most of we don't really use any weak oracles, but yeah, you'll see it costs like, $1 billion to pump the price up 10%. That's considered, that's probably a pretty safe oracle. But yeah, we try to expose as much data to the user as we can.
So, as you move down this route of evolution within your company, do you see the work that the DAO will be required to do as being anything differently? Are they going to be given any new tasks or responsibilities, or are they just going to have less responsibility?
They're going to have different responsibilities, but they're not. We are actually trying to remove as much governance from the process as possible. We think that governance is, I think that's one thing I think even Uniswap did correctly, in my opinion. Uniswap doesn't really have any control over any of its pools, and I think that's great. A lending protocol has some more caveats, right? We have liquidation fees and all those things, but we think that by going permissionless, we can sort of allow users to gauge that risk, and if they don't like the market, they can create their own, right?
Yeah, great question. Because I think what CryptoJesus is trying to highlight is there's a tension in the implementation of smart contract and the ability to update those smart contract. And we saw the consequence with Euler Finance, right? There was a hack of $200 million. And I think that's in the back of Jesus' mind, I could hear that that reference, like, is you guys are facing the
Yeah,
same
and
risk.
that's thought about the Euler Finance because they're a great team. So it was.
Yeah, no, exactly. Great team that tried to do everything right. Like they've had audit for every single new line of code they introduced. They've paid a lot of money for also bounties for people to actually try to hack their protocol. And it turns out that the hack was very tricky because it was within the contract. So it could happen in the last 8 months. So it was dormant there. It was a weakness that someone exploited, but it wasn't a new, or I guess, was it new or had it been there for like 8 months or so? I mean, I'm getting confused a little bit.
Well, the feature had been live for 8 months. And it had been audited by Sherlock. So it didn't go through the initial release of audits. I think Euler had something insane. I mean, I just want to preface this with saying the Euler team is amazing. I met some of them at ETH Denver, and they really do care about security. They use great auditors. They use Certora, which is an invaluable tool. I think it's more valuable than audits for the most part. But yeah, the code was audited with Sherlock, which is a sort of audit competition, but it was missed. And that's just something that happens with upgradable proxies. If you set them in front of your contract and you choose to upgrade something, as soon as you do that, it's just a completely different protocol. So yeah, we don't use upgradable proxies. That's kind of just part of our ethos. We don't upgrade anything. If we're going to upgrade anything, it's going to require users to migrate their funds.
Yeah, that's awesome. But yeah, you guys, so, I know we were talking about Arbitrum earlier. You recently announced, launching on Arbitrum. Any reasons why you chose going on Arbitrum, and is there any plans to expand to other protocols in the future?
Yeah, so we chose really Arbitrum. We were in between Optimism and Arbitrum. We think that L2s just had kind of the superior tech and community to an extent. But yeah, we chose Arbitrum really because of the amount of native projects and the liquidity underlying their native tokens. At Silo Finance, we focus on serving underserved markets, things like DopeX, things like Magic, things like GMX. So things that have really their own communities and these native tokens that are vastly liquid. And Arbitrum is definitely king at that. They have just a plethora of projects with incredible tech and innovation, and also healthy enough liquidity to make markets on top of, which is very, very important. The two most important things in the lending protocol are the oracle and the liquidity of the underlying token.
I think you made a great choice, honestly, and it's coming at a perfect time where obviously the Arbitrum token drop is coming around. And that means, one, we're going to see a lot more liquidity for active users that are already on Arbitrum. So, the small community will probably increase a bit in all these other sub-communities. And two, obviously, we're going to get a lot of people that are going to try to get a chunk of this token drop in the meantime between now and, I believe it's March 28th. So it'll be very interesting to see how Arbitrum evolves from this token drop. Look at Optimism pre-token drop. They relatively had no users, and then they did their token drop, and then all of a sudden they had users, right? It's going to be very interesting on the Arbitrum side because they already have a shit ton of traction, development, creator content, and users, and liquidity, right? So I'm excited to see how this unfolds.
Yeah, I would agree 100% with you. I don't even know to what extent Arbitrum is going to grow because, man, Arbitrum, people don't need people could go to all these other chains to get incentives, and they still choose Arbitrum time and time again. And I think there is a reason for that. I think the first time I used Arbitrum, it was like magical. Like I clicked the button and it instantly filled my transaction. And it's always done that for like the whole time it's been there. So I'm super, super excited. And, hopefully we get a nice chunk of these Arbitrum tokens and we can spread them out to everyone here. So.
Yeah, just to follow up on Jeff's question, right? Like if you were to go cross-chain and to expand beyond Arbitrum, let's say you wanted to go on Optimism, maybe Polygon, or even Solana, is there a strategy for it? Would you leverage something like layer 0? Do you have any opinion on cross-chain lending? Like, what does that look like in long term?
This is something that we are still looking at for our V2, but we do know that we want to be on the other layer 2s, like Optimism. And we do know that after we kind of have this permissionless and all these different features, we'll have a very aggressive expansion of multi-chain expansion. So yeah, probably Optimism next, and then probably hit the big ones like Polygon, BNB.
Looking for it. Yeah, I like that last part that you said, BNB. But just kidding. Going forward, so aside from launching on Arbitra, like what are some of the new products that you guys have put out recently or are putting out in the coming days or weeks?
So we have the Curve LP tokens that I spoke about. That's it's an audit with chain security, and so we've been just figuring out a solution to be able to support as many of the LP tokens as we can. I don't know if you know much about like the code base of Curve Finance, but it's a zoo in there. So like there is like maybe like 4 or 5 different types of pools. So it's it's definitely a difficult undertaking, but that should be coming relatively soon. And then we are working on some GLP, GMX stuff, but I will not name which one yet.
Sounds interesting. And I guess just with everything that's happened recently with, USDC and the banking and the stable coins, anything that you guys are considering as far as your approach as to what stable coins you're using on your platform, or has there been any change in sentiment with the recent developments?
Well, I think that we love LUSD, right? We really do, but there is a problem with LUSD, which is that it does depeg upwards. If it maintains stability at $1, then we would love to use it. But for now, we're still going to stick with our USDC. But it's funny you mentioned it. We were actually full crisis mode during the whole DPEG scenario, so we made sure to safeguard the DAO's funds and kind of spread it out between FDIC insured accounts and whatnot, because just the whole USDC fiasco was crazy. But yeah, oh, my colleague here, Aham, just came on as well.
I don't see him, but if he wants to request and come up, we'll gladly let him up. I don't see his account.
Yeah, I believe his internet died down for a second there.
So was there huge concern within your community that you had to kind of quell for obvious reasons when the whole USDC debacle went down? And I think we all knew internally, the people who were viewing liquidity, the people who had, insider over here from SVB and all these other separate entities that, the worst case scenario was that they would maybe lose a few cents on the dollar, right? But obviously, stablecoins are a huge part of your ecosystem.
Yeah, so stablecoin, we have our own stablecoin, and so the biggest concern came for us because we are paired with USDC with our stablecoin, and then we also have a massive treasury of USDC. But I mean, we took steps to secure that, and we have a sort of a plan in place in a worst case scenario. But I mean, at the end of the day, we were really being extra careful. We think it's USDC was fine, and it was probably going to go back to normal. I didn't see a scenario in which either Circle didn't just pay off the difference, or they weren't covered by regulators. But just always better to be safe than sorry.
I absolutely agree with you. But I think one step safer maybe within this ecosystem might be an asset like DAI because it's over collateralized, right? Because obviously your USDC is collateralized 1-to-1, and God forbid anything were to happen like this again, and an entity weren't bailed out or weren't didn't have depositor funds covered, then they would be out some number of cents on the dollar, right? And that's just obviously money they would have to take out of their own pocket, or Coinbase as an entity because they own 50% of Circle and they're not going to let them go down. But still, right, it can create a lot of pain for all of these organizations involved. Meanwhile, you have an asset like DAI, and yes, 60% of the collateral within DAI is USDC, but DAI in the first place is over collateralized, right? It's 150% collateralized. So when USDC depegged, really the collateralization really only went down to 145%, while the asset itself, DAI, was trading under $1 within specific liquidity sources. The value was also there, right? It was still 145% collateralized.
Yeah. Oh.
I just want to say something. Sorry, guys, I wanted to join earlier, but I actually lost electricity. We had a storm.
Oh no,
Yeah, but
welcome.
we're good now. Thank you so much. So I just want to say about DAI, I think the problem that because you could redeem technically because of the PSM, you could redeem it 1-for-1 at all times, and that is probably a lot of people did. So it really didn't matter much the over collateralization or the tokens or token assets that backing it in different PSMs. The idea was that we've seen with DAI and the rest of the space is that we are DeFi is exposed to the risk of CeFi, and we're basically addicted to it, all of us, because of all centralized stable coins, from USDT to USDC to Paxos to whatever that is. And I don't think DeFi is going to be secure until we have a scalable decentralized stablecoin. And I think that no one has cracked this up yet. And I don't think it's going to be done because there is little incentives right now to actually work on that, simply because USDC and USDT are widely, broadly adopted. And even look at, for example, the routing that happens in Uniswap v3. It's mostly done through USDC. And so the whole DeFi is built on this very insecure layer. And yes, if something happens with the banking system in the States today or in the world, DeFi will just disappear if USDC just goes away or for some reason. It doesn't need to be actually depegging by much. So we're as a space, we're addicted to those stablecoins, and no matter how the way you kind of try to secure it, be it 150% over collateralization or whatever that is, it's just not gonna work as long as you are pairing it with liquidity paired with these stable coins, these centralized stable coins. I don't think we can resolve this right now. Honestly speaking, just simply it's not working. ADSD is not scalable. We know that, and there isn't any way to fix that, not without huge compromises. And I don't think anyone is willing to kind of sacrifice that, because you're sacrificing scalability for security, and you know we're the whole system is built on the idea that just pump TVL in the whole system. So it's a big problem.
Completely agree with you. And thank you so much for joining us. I'm glad you have electricity. I know how that is when that happens. You're kind of disconnected. But yeah, I completely agree with everything that you said. And just the fact that, you know, people are talking about it, like I'm hopeful that like founders and developers like you saw yourself and some of you guys up here will come up with a better solution for the future, because I agree, like we know it's not going to work long term. We have to come up with a better way of fixing this issue. But yeah, go ahead, Tens. I saw you unmuted.
Oh yeah, I was just gonna say I'm really hopeful to see what the Curve guys come up with, you know, for Curve USD, and I think that to a certain extent, a decentralized stablecoin has to be paired with decentralized assets because of the liquidity issue. So that will probably come down to a custom AMM. So someone needs to sort of create this, decentralized USD ETH pool that is hopefully not murdering people with IL, so that it's also scalable to the masses. But yeah.
Yeah, that's going to be an interesting experiment. It will be severely limited by the liquidity depth, because if you look at the curve pools, the way they're, I mean, the biggest ones are actually stable coins that are either wrapped USDC or simply, it's simply like other centralized ones. And that's going to be, but yes, it will be an interesting experiment.
A quick question, nerd question. So when it comes to blockchain, we have the blockchain trilemma, right? Like most people know that we have scalability, security, decentralization, and the consensus. You can only do two out of those three things. It sounds like what you guys are saying is that there's also like a stable coin trilemma, where you're trying to have it to be secure, to scale, and maybe to keep it speg, but you can only do two out of three. Is that a fair assessment of the situation?
I would say so. Yes, I would say that it's almost the same trilemma. But yes, 100%. Liquidity is a huge part of it. For example, even if you had LUSD during this drop, obviously LUSD trades at 1.05 most days, but you saw that it lost peg with USDC, and that's not a surprise. LUSD was largely paired with Frax, which is paired with USDC, and it was paired with USDC itself. So, if the USDC peg goes down, then so does the LUSD peg. So yeah, liquidity is, I would say, the problem to solve for a decentralized stablecoin. If you solve that problem, I think the other things kind of fall in line.
Completely agree. And I hope I'm saying your name correctly. I know you joined us late, but is there anything that maybe you wanted to highlight about Silo before we see if anybody has any questions? Yeah, if anybody has any questions, feel free to request in and come up. Anything that you're excited about that you guys got coming out, or anything you want to leave us with?
Yeah, I just want to actually mention a few things about the space, and this is kind of a personal opinion, and a lot of listeners, so it's good to kind of like raise this flag about security of different dApps. So we're all users as well. So please pay attention to where you're putting your money. It's it's not a good experience when people lose money. I think we should pay attention. We should objectively look at protocols and ascribe risk kind of profiles to them. And that's not happening right now. What we see, and this is also applies to Silo, by the way, I'm not kind of singling it out. What we're seeing today is that if some parties have interest in a protocol, they can create a narrative that it's super safe, go use it, while in DeFi, there are certain facts. There's time-based trust is important. So protocols earn trust with time. Upgradability. If protocols upgrade, with every upgrade, risk or trust resets to zero, and we don't see that. We actually see users thinking that, well, trust continues, which is in fact not true. And there's also this narrative that DeFi is safe. It's actually never safe. It's never going to be safe, simply because it's just composable. There'll always be unknown risk as well, and knowables. And because of you built a dApp on top of a dApp on top of a dApp, and it's going to be a problem. Let's take, for example, Silo. We isolate risk. But if we also use a stablecoin across the protocol, yes, we isolate risk most of the time. But if USDC depegs, well, that's a contagion that will spread across all protocols, and we cannot shield against it. So users need to understand that. Yes, we isolate risk. I think we're pretty much better at that than all lending protocols. But there's also risk. We also have another risk of oracles. We blindly read the price from Chainlink, like Aave does, like everyone else does. And that's another layer of risk that users need to understand. Yes, we all trust Chainlink, but can you trust just infinitely? This trust doesn't work like that. So we're at Silo, we don't have upgradable contracts. So we basically, what you see will never change. We cannot change it. DAO cannot change it. That's it, which is great. It's kind of like we hope that we're earning trust every day. We're seeing TVL going up, which is great. Our V2 is going to be much, much simpler and hopefully scalable. So I'm excited about that. I'm not going to reveal much about it. But today, I really would love if all DeFi users looked at protocols and assess the risk objectively, not be blind by certain numbers like TVL. TVL doesn't mean anything. You could have actually a VC pumping $1 billion and you would never know it, and you would think that large numbers of users are using it, and that could be a fallacy. That could be simply a social proof engineering to kind of like hack your perception. You would think that because of large numbers of users using a protocol, then it's safe. It's actually not true. We've seen it. So that's kind of like what I would like to communicate today. I think it's really, really important we all understand it.
I completely agree with that. Like, I'm not a deep DeFi user, but for me, like when I go looking at DeFi protocols, you go and you're like, hey, this has a huge TVL, it must be safe. But I guess with that, like as a, not deep DeFi user, are there any tools or websites that kind of help a user find out which DeFi protocols have, like, is there a rating system? I don't know. Am I
Yeah.
asking for too much?
I don't trust any rating system today. Certec has one. I don't trust it. I'm sorry. All the respect to the team. I don't trust it. I don't recommend anyone trust it. It doesn't work like that. Just because you have few audits are redundant the moment you change a single line of code in upgradable protocols, obviously. I actually spoke yesterday to a team of engineers that happened to be also a VC, Electric Capital. They just a disclaimer, they actually hold tokens in our project. They're working on a tool that would have kind of an objective rating. That's number one. Number two, I just yesterday spoke to the Certora team, formal verification tool, well respected. It's actually the tool we use to always make sure that our code is safe. They're coming up with a monitoring tool as well for the code. I think that will give also some sort of visibility into code bases of different protocols. There isn't really a rating system that today that I'm aware of that kind of objectively look at code, and it's really pretty much what you see is a rating system based on have they done an audit? Yes, let's give them 10 points. Have they been on the market for a year? Let's add another 20 points. It's really not necessarily. It gives you basically kind of, I think, an illusion of trust, but we don't have something today that I would personally trust.
I would agree with that, but even though we don't have something that's let's say optimal, right? At least we have a beginning of a rating system, right? The one that I think is not necessarily comprehensive, but give you a beginning of an answer is DeFi safety, right? In the sense that they actually will give you a full report of the protocol. To Tame's point, right? They'll kind of give point based on they did the right thing. It's hard to know for sure if something is fundamentally safe because, as Aim was saying, everything is interconnected, right? We're kind of building on top of existing protocols, on top of existing protocols. So there's risk of contagion that you can't read in the report, that you can't read in the score. But at least, like, there's some effort in that direction. So to answer your question, Jess, there's
Yeah,
a few projects, including DeFi safety. Like
yeah,
it's a list of scoring based on audits, based on documentation, testing, and incidents as well.
right. Absolutely, there are pieces that you can kind of like put together to arrive at something. But personally, I never put a dollar in an upgradable protocol, no matter what because things can change without me knowing, and that is the biggest problem. And let me just to tell you like. One example, like a year ago, X Sushi was listed on Aave, and X Sushi you could actually mint it, and the token protocol, the token contract address had an issue, and it was listed as collateral on Aave, and that could have been a massive exploit to the entire protocol, and that was not an Aave problem. It was actually just coming from an external code base. And no one knew about it, even in the system, just people missed it. So those kind of like things you're never aware of, you're not aware of. So I would say number one, if a protocol is upgradable, just that is a big no for anyone. And we've seen it with Oasis on top of Maker. It's upgradable. Yes, people didn't lose money, but basically took custody of the money. We've seen it also with other protocols. So upgradability, I would say, that is a big red flag immediately because things can change without you knowing.
Yeah, that's a good tip. Go ahead, Jesus.
I would just put out there that the vast majority of protocols and companies on top of the blockchain today have centralized front ends. So they can upgrade their front ends at any point in time, while their back ends may be decentralized, your liquidity pools and your smart contracts on top of Ethereum mainnet or whatever other chain you're on. The front ends are not. And obviously, the vast majority of users interact with these smart contracts, interface with them through these centralized front ends. And what they don't realize is that in theory, a malicious actor, a malicious employee, or a hacker could deploy a visually identical front end interface and steal millions of dollars before anyone noticed that it was connected to malicious contracts instead. But the larger issue is censorship resistance, right? Because if you live in one of the countries that, if you're one of the 1.86 billion people who live in countries that have just outright banned crypto, they can at any point in time just block any website they want. Any country can, right? There's plenty of corruption and inflation all over the world. And this is why crypto was really created in the first place, right? The value proposition of decentralization. But none of these front ends are decentralized. So I would love to hear your take on that.
Oh man, hey, you may bring up such a great point. So yeah, I would say that the three primary kind of risk factors are: we have smart contracts, we have economic attacks, and we have front end attacks. And what you're saying is not far fetched at all because this is exactly what happened to Badger, right? someone updated the front end. I think they hacked their GoDaddy profile, where they called in and they managed to get access to it. And then they just swapped out the contracts and had people approve money to their malicious contracts. So definitely something to keep an eye out. And I do think that decentralizing the front ends is also a great idea. And it's also one of the reasons I admire what Liquidity has done, right? Liquidity does, for those of you who don't know, doesn't have its own front end. It actually, people run their own front ends, and then for that, they get a cut of the fees. So you can choose the front end that you trust.
I think it's a great model to decentralize, and I think it's a must. There's always a trust. You have to trust someone eventually, even in any front end, honestly, unless you know how to interact with the blockchain directly with the contracts. Yeah.
Yeah, and there are also some people working on safety around this. I believe the Yearn people have sort of created this. I don't remember exactly what it's called, but it's essentially a thing that when you create a transaction, it checks that the contracts you're interacting with are the correct contracts, and that the functions that you're accessing and sort of everything that is going in through your wallet is correct.
Yeah, I think that's a great topic because we've already seen some of that. The front end being blocked in the U.S. Like we saw it with the ape staking. I actually had it as one of my topics. Orca. I don't know if you guys are familiar with the Orca DEX on Solana. They just announced they're going to be blocking its interface for U.S. traders. So I don't know if this is going to be like a pattern that we're going to start seeing, but it's definitely worrying that, like you said, like then, as I don't know how to read smart contracts. Am I going to have to, interact with the blockchain, and what are then the vulnerabilities for users, and the fake UIs that can get created. So it sucks. But yeah, that I think we may start seeing this happening more on DEXs. But yeah, or I can just move, which that is my second option. My moving out of the United States.
Brazil is nice this time of the year. Nice Caprina. The beach is amazing. Just saying.
Yeah, no, it's certainly difficult. Ourselves, we are we have, man. I mean, the legal aspect of the U.S. is really hard to navigate. Nothing is clear. So most protocols just opt into just blocking the U.S. But yeah, that really has to come just from clarity of the U.S. If the U.S. doesn't want to partake, then maybe what we need is actually something akin to the dark web, but for DeFi. We need a way for users to access from other places. And hey, VPNs, right? That's probably easier than moving.
Or we all buy a piece of land and we all move to it. It's all DeFi people and have all the no regulations.
We should talk at some point, guys, on building a decentralized application style web explorer.
Oh, wow. Definitely.
That would be dope. But yeah, Mika, I saw you came up. Anything you wanted to add to the conversation? Welcome. Maybe not. All right. Well, yeah, I really want to thank you guys for coming. I think it's been a great conversation. Anything that you want to leave us with? Anything coming up that we should check out? I know you had mentioned something. You have a rewards program going live. You want to maybe talk a little bit about that?
Yeah. So obviously we mentioned the Curve LP tokens and possible other integrations. V2 coming later on. But yeah, we just launched our rewards contract. We previously had grown completely organically, but now we're starting to use some of our DAO revenue to incentivize actions within the protocol. Wraps. We're starting with the basics on Ethereum, which is wrap staked ETH deposits, our ETH deposits, CB ETH, and own borrowing. And then on Arbitrum, we just started some incentives up with Dopex and Magic. So you can earn some silo tokens there without needing to buy them. And yeah, this is also sort of a trial program. Rewards are quite nice right now, by the way. But yeah, so we will have a much bigger rewards program coming for our V2.
I just want to thank you so much for having us, and would love to kind of connect with any one of you guys. Just reach out to us. We're open to kind of any opportunities. We're here. We want to be here by 2030 when DeFi is going to be in the mainstream. So we're working on that. Actually, we're long term, and we're still very early. That's why we kind of build slow, ship slow, baby steps, and we really super excited for the future of DeFi in general.
Go ahead, Sal.
Last question for me, because you guys are like on the frontier, right? You're kind of building the future of the space, and you touched on some of the problems. But on the more positive light, what are you guys really excited about? Maybe like a technical update, something like ZK rollups or Eigenlayer, anything that's on your radar that you're really, really excited for?
I'm a more conservative person. I'm actually excited about Arbitrum and other L2 scaling and the interoperability between them to create a great L2 experience for users. So technically, it will be like L1 and L2 all together, like one big experience. That's to me kind of more realistic ZK rollups. Absolutely, super excited about it, and would love to kind of once the Polygon peeps launch their chain, would love to also be there. And but I'm more kind of like I would love to see Arbitrum scaling to 10, 20 billion. That would be just great for users because I think it's just a great experience.
Yeah, I hadn't thought about that, about just like the L2s connecting with each other. Like, I don't think we've seen a lot of that yet, but that's going to be interesting to see how that plays out. But yeah, thank you guys again for coming. We really appreciate you taking the time out and letting us know about Silo Finance. I did pin some tweets on top in case anybody wants to check it out.